I believe that up until a week or two, a few weeks ago, maybe only for a week or two in when gold was peaking, there were net purchases in the ETFs. But long and short of it is the number of tons of gold held by the exchange traded funds in the West have been kind of falling. So as the price went up, retail investors have been coming out of gold and going into tech stocks. But the gold price keeps going up. So it's not the retail investors who are involved in the market, it's someone else. And now these could be big hedge funds, it could be central banks, it could be the US government itself, we don't know. But there's someone out there who is buying gold at the same time as retail investors are selling it. Why? Who is this buyer? Who are these buyers? We don't know.
Central banks are quietly driving gold to record highs, far beyond the view of retail investors. Clive Thompson observes a clear pattern emerging across global gold markets, shaped by both the behavior of central banks and the shifting actions of retail investors. He points to a recent World Gold Council survey, which shows that many central banks plan to increase their gold holdings this year and next, reinforcing the steady accumulation already visible in the market. However, he stresses that official data lags badly, with most figures only updated through June. Because many central banks report with long delays, or choose not to report at all, the true scale of current buying remains hidden for months. Thompson contrasts this central bank activity with what is happening in Western gold ETFs. Until just a week or two ago, these funds were still recording net outflows, aside from a brief spike when gold hit its peak. The overall tonnage held by ETFs in the West has been steadily declining as retail investors move out of gold and into technology stocks, even as prices rise. This divergence, he argues, makes it evident that retail investors are not the force pushing gold higher. Thompson believes the upward momentum is coming from large, opaque buyers, primarily central banks. He highlights China as a key example, noting that while its official gold purchases appear modest, the actual amount is likely far larger due to unreported inflows and delayed disclosures. He adds that fewer central banks globally are reporting their gold activity at all, suggesting broad-based covert accumulation. This hidden demand, he argues, is a major factor behind gold's rise to the $4,000 to $4,400 range. In his view, central banks are not buying for short-term profits. They are building long-term reserves and positioning themselves for a future less dependent on the US dollar. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors. Don't forget to tap the bell icon for more daily insights into the financial system. Thanks for watching.
We've seen a lot more central bank buying in the last few years, and many of the indicators are that some central banks are buying gold and not telling anybody about it. They're doing it covertly. The biggest candidate for that is China, where they have they produce about 20% of the world's gold from their own mines. There's also, and I don't have concrete evidence of this, but there's a lot of people who seem to have done the research and got the evidence. There's also large quantities of 400-ounce bars being exported from Switzerland and the UK to China. And these are not the sort of bars which are used at the Shanghai Stock Exchange, which uses 1 ounce, 3 ounce, 100-ounce bars, and then 1 kilogram bars, and they're not the sort of bars which are used in the jewelry industry. So these are the sort of bars which are used by central banks for storage. So there's the internal production coming from China's own gold mines, perhaps 20% of it going into their reserves, secret reserves. We've potentially got a lot of bars moving to China, which we don't know where they're going, but they're the type of bars which would be held by central banks. And then the last thing we've got is since 2014, China's official reserves, which is basically treasury bonds and gold and special drawing rights, the official reserves have plateaued. Now, that's odd when China's trade surpluses have ever since continued to climb every year. Their trade surplus has been climbing, their current account surplus has been climbing. So for decades before that, as this trade surplus was climbing, the reserves would go up. It wasn't a one-for-one match, but more surplus trade means more money in the central bank. Suddenly, it seems to have plateaued since 2014, which kind of implies they're still potentially building up the reserves, but they're not reporting it. So why are they not reporting it? Because perhaps it would hack off the Americans to know they're buying gold. So they are buying a little bit gold. That's officially reported numbers, but the numbers that they're buying, whilst they're pushing up gold as a percentage of their reserves on the balance sheet, it's still looking like it's relatively small. But reality, it's probably quite big. And I expect the central banks around the world, which are also building up reserves. I saw an article saying that there's less central banks now reporting their gold purchases than ever before. So implication is there's probably a lot of buying, and that's probably why the gold price has reached an all-time high of 4,000. Well, the high was a bit higher than that, 4,400, but let's call it 4,000 for simplicity. And speaking, most central banks are insensitive to the price. They don't care. They're not buying with a plan to sell tomorrow to make a profit. They're buying because they want a plan B, which does not involve the dollar. Exactly. That's on the World Gold Council's website that they surveyed the central banks, and a large percentage of them said they will increase their gold holdings this year and next year. And of course, from what we know, that has been happening. But a lot of the statistics are very, very out of date. There's a huge lag between, I think we can only see it up till June at the moment. So obviously, not for, some banks have got it right up to date, but the official number for when you add up all the central banks is probably only June, because many central banks don't report, or they report with a long lag. I believe that up until a few weeks ago, maybe only for a week or two when gold was peaking, there were net purchases in the ETFs. But long and short of it is the number of tons of gold held by the exchange traded funds in the West have been kind of falling. So as the price went up, retail investors have been coming out of gold and going into tech stocks. But the gold price keeps going up. So it's not the retail investors who are involved in the market, it's someone else. And now these could be big hedge funds, it could be central banks, it could be the US government itself, we don't know. But there's someone out there who is buying gold at the same time as retail investors are selling it. Why? Who is this buyer? Who are these buyers? We don't know.
Investor demand is igniting a powerful surge in silver and gold mining stocks. Clive Thompson highlights a developing dynamic across both the silver and gold mining markets as investor behavior begins to shift. He notes that silver has been outperforming gold in the early stages of the current bull market. Although higher prices may slightly dampen industrial demand, he argues that this is outweighed by rapidly rising investor interest. The Silver Institute expects around 200 million ounces to be purchased for investment this year, a figure that underscores how tight the investment market already is. With global supply limited, even holding a single ounce places an investor ahead of many others who will not be able to secure any. Thompson warns that if investment demand doubles to 400 million ounces, whether due to more buyers or individuals wanting multiple ounces, the strain on available supply becomes extreme. Mine production is relatively fixed, leaving recycled silver as the only additional source. In his view, this means higher prices are not just possible but necessary to unlock more secondary supply and meet growing investor demand. At the same time, Thompson sees a parallel shift emerging in the gold mining sector. He notes that even a small fraction of capital from major tech companies could dramatically reprice mining equities. NVIDIA's market cap alone, he explains, is large enough to buy the entire global gold mining industry 4 times over at current valuations. Let's get back to the video.
Silver has outperformed gold in the current bull market. And I say bull market because I think we're still very much at the early stages of that. Obviously on the industrial side, it's a possibility that the demand will slide a little bit at the higher prices, but that's counteracted by the investor demand, which now wants to buy silver. Now, the Silver Institute is forecasting that investors will buy 200, I think it's 200 million ounces of silver in investment gold this year. When you divide that number out by the population of the planet, you'll find that's one person in 45 or something like that can have 1 ounce. Now, I know half the world probably can't afford anything in silver, but even so, if you think about it, if you have 1 ounce of silver alone, you're already ahead of the other 46 who won't be able to have it because there just isn't enough. If that 200 million ounces figure, that estimate going into investment demand is correct. Now, if that figure it turns out to be 400 million ounces, because actually there's more than one person of 47 wants to buy an ounce, or that one in 47 persons wants to buy 2 ounces, well, where's it going to come from? The mined output is relatively inelastic, so the only place that extra silver can come from is recycled silver. And the only way you get recycled silver is to have a higher price than yesterday. If you look at it, just a tiny fraction of Nvidia's market cap or Microsoft's market cap or Apple's market cap and so on, if that was to find its way into the gold mining sector, Nvidia's market cap could buy the entire gold mining sector 4 times over if the price was where it is today. So if you could imagine just even a tiny percentage of Nvidia going to the gold mining sector, those shares would go through the roof. And now we've seen a very large rise in gold mining stocks this year, indicating that there is some interest in gold. But I can tell you factually that many banks who say they've been promoting gold don't actually have any gold in their client portfolios yet, or just starting to put it in. I think it will go in 2026. It's a very long and difficult process when you decide to go from zero in an asset allocation to anything above zero for any asset you like. I know that because I've worked in banks all my life, but just so, I mean, people think, oh, it's easy. The bank decides we're going to put 5% in gold and it's done. It doesn't work like that. Let's say the chief investment officer decides that 5% in gold would be a good idea as opposed to zero or 1% or whatever the number is. There's multiple departments now need to be involved. You need to have the legal and compliance departments involved to make sure that is legal under the rules of the country in which you're operating. You need to look at the types of clients to find out if there are certain types of clients where that would be not allowed. For example, in Europe, if you take Luxembourg insurance policies, which there's many of them investing through Switzerland, the Luxembourg insurance rules do not permit the holding of physical gold. So, these are things which legal and compliance have to look at. You made a decision to do it, but they've got to look at it and say, okay, let's take it client. It may be illegal or not allowed for clients in certain countries. Then you've got to look at how are you going to get your exposure to gold? Do we buy the physical metal? Do we hold gold in account? Do we have an ETF? Do we do it through the miners? Do we make a customized instrument, a structured product to do it? Do we go for a hedge fund? There's lots of different ways of getting that exposure. So that has to be examined by a department who looks at all the possible ways of getting exposure to see how it can be done and how they want to do it. And they're looking at things like liquidity. Can we move enough money in size? You then need the custody department involved to make sure that whatever way you decide to do this, you have the right agreements with your counterparties, because every bank will sub-custody with a third party. It's easy with shares. If you're buying shares, you know where you're going to deposit. It's going to be the DTC, and it's going to be just the same for Microsoft as if you bought an ETF of gold. But depending on how you're going to do it, you've got to make sure the custody arrangements are correct and properly documented and in place, and the fees are all agreed and everything like that. So you then need to get the investment committee of the bank on side. So it's not just this chief investment officer saying, I want to do it. The whole committee's got to be on side. And you probably have to involve the senior management of the bank as well, because this is a change. You may need to involve the client-facing side to get a feeling for what clients are going to think about this as well. So it's a long process. So probably people have started thinking about putting gold into the portfolios in the middle of the year. They're probably now in a bit of a rush to try and get it agreed as part of the asset allocation for 2026. And I guess in the next few weeks, most banks will be publishing their asset allocation tables of what they're proposing for clients. And I'm expecting many of those to start including gold because they'll have done the donkey work over the last 6 months as to how they're going to do it.
Global gold and silver markets are experiencing a profound shift as central banks quietly accumulate reserves while retail investors retreat, creating a disconnect between price movements and visible market activity. Investor demand for silver is intensifying amid limited supply, pushing prices higher and making even small holdings significant. At the same time, gold mining stocks remain undervalued relative to major equities, with the potential for dramatic gains if institutional capital rotates into the sector. These trends highlight a market increasingly shaped by strategic, long-term positioning rather than short-term speculation, suggesting that both precious metals and mining equities are poised for continued upward momentum. Ever wondered why gold and silver are soaring and where investors are putting their money next? So stay tuned. Don't forget to like and subscribe for more daily insights. Thank you for your support, and I hope you enjoy the video.